Adil, bringing you a review of FTSE 100 UK indices from an intermarket analysis perspective. Okay, before I start, I just need to confirm that these charts are via Pro Real Time. It's a premium subscription, and for those of you that want to certainly subscribe, then certainly go to prorealtime.com and certainly obviously subscribe from there. My charts basically are via Pro Real Time. The only charts that I use with my IG Index platform is and that's also via Pro Real Time, by the way, as well. There's a premium version of the Pro Real Time service. Those of you that want to do that, send me an email and I can send you a link, and you can certainly access your charts from a Pro Real Time direct, and that's certainly obviously a premium service again. Having said that, it's done via your CFD platform, and it gives you more data as well, and you also get service directly from the prorealtime.com as opposed to the rest, so that's certainly worth doing. Let me just see the email, if I've got the email here. Have I got the email? Bear with me. Yeah. How does Pro Real Time trading? Here we go. Okay. So here's the request. Following your request, Pro Real Time Trading, thank you for opening an IG account, blah 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 blah, etc. So that's certainly worth doing. Okay. Now I already had one, so I've reapplied, and after speaking to Pro Real Time, and hopefully I'll be working with Pro Real Time going forward to see if I can obviously promote their services for the betterment of all the traders out there, and certainly is a very good charting package. I constantly get asked which charting package I use, etc, etc. Well, it's Pro Real Time premium version. Okay, I have the indices, I have the global indices on there. I've got my obviously my forex pairs on there as well, and certainly worth taking out from a future perspective. Okay, to get professional charting. Okay, and obviously the correct data for data as well, because it makes a big difference with regards to your trading. Okay, so that's that done and dusted. Okay, so let's get on to the market. So basically the US markets flushed. I'll be doing a separate video with regards to US markets and explaining exactly what's happening there, and I'll be elaborating on the reason why the US markets flushed, and all the pros and cons of the arguments of the market cons obviously going higher or going lower. So that's going to be debatable. Okay, I'm just going to look at it from a FTSE 100 perspective, because first of all, in Europe, the European indices obviously are quite stellar. Okay, if you take a look at the DAX, for example, yes, we've come off slightly, but if you look at a daily chart, it's nothing really. I know we've got this rising contracting wedge pattern, but the volume's still there, and certainly from my perspective, it's only a small blip compared to the US markets. So given the fact that Mr. Draghi has said that it'll be unlimited QE, 60 obviously a billion per month, and also he's going to be buying negative bond yields, then bonds with negative yields, and to be honest with you, that's very bullish. Okay, from a market's perspective. Now, whether or not that means that the US markets are going to force the European markets down, that's a different, obviously that again something that I'm going to tackle and elaborate on and discuss as well. Okay, but for now, European markets are certainly bullish from a fundamental perspective, and from my perspective, I will certainly be buying them on the dip. Okay, given the fact that the QE obviously is in full motion, even given the fact that I did expect QE, the market to sell off based on the announcement of QE, given the fact that it's all factored into the equation, and what happened, lo and behold, the DAX went and made a new high. Okay, that's very bullish. Okay, that means that the market is not thinking that from that perspective, and also given the fact that he released two caveats or two additional pieces of information, i.e. it will be open-ended, i.e. it will be unlimited until they reach their objective and target goal, okay, of obviously fighting deflation and increasing growth, etc., and jobs and so on and so forth. Okay, then the other factor as well is the actual purchasing of bonds with negative yields. Okay, so from that perspective, what he's trying to do is he's obviously reducing borrowing costs. That's the whole concept of QE. Okay, is you basically annihilate the yield curve or the interest rates, i.e. borrowing costs, bring them down. Okay, you flood the market with excessive money. Individuals are no longer able to purchase bonds as a safe haven or as a good rate of return. They're forced, and this is what they constantly state on CNBC, yield compression. They're forced to search for yield elsewhere, and obviously then you're forced to embrace higher, riskier assets, which in turn obviously creates a risk-on atmosphere because everybody's going towards equities and going to other alternative asset measures. Okay, and basically it spurs the economy and increases growth rates and so on and so forth. Okay, animal spirits, call it what you want. Okay, so that's the whole concept, especially with regards to Europe, and it basically fights off deflation by creating inflation. Okay, and that in theory, given the fact that everybody's equity portfolio is going higher, obviously equity portfolio could include housing market, could include many investment vehicles. Okay, the whole concept is that risk is embraced. Okay, and there's a mad dash or a search for yield, and everything then tends to appreciate, and there's a feel good factor, and the consumer confidence clicks back in, investment obviously is spurred, and so on and so forth. Okay, and one of the biggest problems obviously post credit crunch was the portfolios. Are absolutely obliterated. Okay, so the housing market starts to pick up. Generally speaking, everybody's portfolios start to improve, and that gives them that feel-good factor, and obviously the whole thing of reviving the economic model starts again. Okay, hence QE, we call it the Kool-Aid. Okay, everybody wants to drink the Kool-Aid because obviously it gives you that ability, just like Lance Armstrong, to be juiced on drugs, juiced on Kool-Aid, and it increases your performance, or enhances your performance. Whether you want to argue it's legal or illegal, that's a different matter. Okay. Right, this is something that we're just discussing. I've just finished a gym session, a circuit session at the boxing club, and the coach was talking about how Lance Armstrong was basically juicing, i.e. he was increasing his red blood cells by taking blood out, storing it, and then putting it back, obviously, and given the fact that he was caught, it's just common practice. Everybody is juicing, so this is why he doesn't respect cycling, he respects running. And having said that, I'm doing a half marathon tomorrow, so wish me luck. Okay, right, going back to FTSE 100. Okay, so the argument now will basically be based on whether or not the tapering, or I won't even say tapering, but hike in interest rates, or interest rates being fought forward to June or September, and the Fed being forced to increase interest rates. And if you look at your chart of the US dollar, this you can see very clearly. If you look at your daily chart of the US dollar index, as you can see, a massive thrust higher. I was expecting sideways, obviously price action, potential break of this channel, and obviously we go lower. Stock market has other ideas. Now, the key, just to focus on this, and this is quite important from my perspective anyway. If you look at your newsfeed, so if I go to Live Squawk, for example, okay, and I just scroll back, okay, and I just go over the jobs numbers, okay. I'm going to do this with you quickly. I shouldn't really be doing this because I want to leave this for the US markets, but just give you an insight, okay? Because it's all about the dollar, isn't it? Commodities move inverse to the dollar, and obviously if the dollar is going higher, then the FTSE will certainly be hit in terms of commodities, but commodities are still quite strong because obviously job growth is certainly there, but the average weekly hours are not there. So I'll discuss this. So US trade balance, minus 41.8 billion, so it came out obviously worse than expected. US change in household employment, February 96, okay, fine, in line more or less. Labour force participation rate, more or less in line. The most important factor was this: US average weekly hours, all employees, Feb 34.6, came out in line. Underemployment rate 11%, okay, more or less in line. Now the average weekly hours is the most important thing. It didn't rise, so that, how can that be positive in terms of dollar? Okay. Second thing, US average hourly earnings, February, month on month, 0.1%. Expected or estimated 0.2%. How can that be bullish? If the average hourly earnings are dropping, how can that create wage growth? How can that lead to real wages increasing? How can that lead to higher disposable income? And obviously we all know disposable income is almost 70 to 80% of the GDP, or contributes 70 to 80% of GDP. So if it's dropped, and it's failed to hit its target by 50%, it's come out half the expected amount, how can that be bullish in terms of the dollar? How can that lead to a raise in interest rates? surprised. I'm baffled. Okay, average hourly earnings 2% year on year, expected 2.1%. How can that be bullish for real wages? Okay, U.S. change in manufacturing payrolls 8k. Okay, estimated 10k. Again, lower. Okay, so U.S. change in non-farm payrolls. Okay, yes, they revised that higher, 295,000 more jobs were created, so on and so forth. That's fine. That's certainly an argument for obviously the dollar moving higher, but the Fed's yardstick isn't the amount of jobs that are being created, isn't the growth rate. It's all about tackling deflation. That's why China's cut rates, that's why Israel cut rates, that's why Turkey's cut rates, that's why Poland's cut their rates. The RBA didn't cut rates, and they've had a lot of negative obviously feedback, because it's a global fight for deflation. Nobody wants to import that deflation that China obviously has been exporting and the US has been exporting, etc. Somebody has to embrace that. So it's a global war on deflation. Okay, and that's why we call it a currency war, because everybody wants to debauch their currency and obviously force it lower and obviously fight off or stave off deflation. So from my perspective, if you look at it from there, it's very hard for me to justify a dollar snap higher. So it basically means to me that it was not much of a dollar move as such. It was more of a euro. Obviously we already know is weak, so therefore that was going to get obliterated or battered regardless. Okay, the Aussie, very surprised how it dropped quite substantially, given the fact that RBA is on hold for now, although they are talking about going forward. That's a different story. RBNZ, Royal Bank of New Zealand, again very surprised that it dropped quite so substantially. Actually, I mean, yes, it can actually. The RBNZ, yes, you can, because the RBNZ basically have talked the market away from obviously cutting rates and started to work on specific housing policies to cool down the property market, and obviously interest rate cut isn't going to be one of them, so therefore one would assume or presume the RBNZ would certainly start to rise. But again, there was some other news, but I'll discuss the RBNZ afterwards. But if you look at it from that perspective, it's very hard for me to justify the dollar spiking quite substantially. Now, even if I look at GBP USD, yes, you can argue that, because the inflation data that came out and the expectations of inflation have dropped quite drastically. So yes, you could certainly argue that the GBP USD would fall. So from my perspective, it seems more of a, rather than a dollar move as such, I think there's a misconception as to interest rates being pushed ahead sooner than expected. So I think it's a misinterpretation from the market's perspective. That's my understanding, and I will not be surprised if we have a lot of Fed speakers next week talking down the dollar. Okay, that's just my expectation. So given the fact that the market's misinterpreted the move, then one would assume that the indices would certainly bounce back, certainly push back as well. Okay, and if I bring up a chart of, say, oil price, okay, the oil price initially, if the jobs data was so strong and was so bullish, then why hasn't oil moved higher? That's the question you need to ask yourself. Okay, why hasn't oil moved higher? Why didn't copper and gold move higher? If the jobs data was so bullish and we were going to get an increase in interest rates based on economic data that was strong, but real earnings were not there. So again, there's a conundrum and a misinterpretation of the jobs data from my perspective. Okay, whether that means they're front running something that's about to happen next week, etc., I don't know. Whether it means that money is flowing towards European equities as opposed to and out of US equities, I don't know. There's going to be some sort of money flow or some sort of rotation, etc., money rotation, etc. I don't know, but it's not making sense from just purely fundamentals, given the fact that the economic data was such. Okay, now I'm going to look at the fundamental, technicals now, given the fact that I've elaborated over basically the Japanese market was higher on a Friday. Yes, China was more or less stable to slightly sideways. Yes, they are obviously talking about growth rates potentially going down to 6 or 7%. That's certainly acceptable, I understand, but that's not had an impact on the markets as such. It's basically the Kool-Aid. It's all about the ECB QE, and the QE is there, 60 billion a month. Markets are certainly going to be continuing to short squeeze higher from my perspective. Very hard to see anything otherwise. Okay, right. Now let's have a look at the technicals now. Was there any economic data on Friday for the FTSE that was of any major importance for me to elaborate on at present? Not necessarily, no. Let's just have a look. Okay, yep, the inflation data, obviously that's the key. So given the fact that sterling is dropping is actually positive, given the fact there's going to be no interest rate increases, that's positive. So overall, given the fact that obviously maintains a dovish monetary policy, it's good for the FTSE 100. And also given the fact that German industrial production data came out higher than expected, again that was considered to be bullish as well. Okay, so those factors, all those factors together, certainly bullish. And Eurozone GDP basically came out in line, more or less in line. So no real concerns or surprises there. Although government expenditure did come out slightly better than expected. So overall, more or less in line, potentially beating. Okay, and given the fact that the US data with regards to average hourly earnings came out weaker than expected, therefore interest rates will be kept on hold. Well, basically kept on hold. No real rates from argument or rate increase argument there. Therefore, it's a dovish policy. Therefore, interest rates on hold. So no real reason to be concerned. Okay, and obviously Greece is out the equation, and so on and so forth. Okay, so very strange for me to see the US market sell off. Very hard to understand. Now let's have a look what's going to happen with regards to the markets now. Okay, so FTSE 100, bring this chart up for you. So this is the FTSE 100. Bear with me. Okay, so this is your FTSE 100. So we're in a rising contracting wedge pattern, which I discussed previously. Daily chart, obviously you can see previous resistance equals support has held thus far. And we have remained within this channel. If we see a sustained move on Monday, then individuals, regardless of the average hourly earnings, individuals are basically forecasting or basically factoring in a dollar rise. Okay, are factoring in a rate increase for June, which again will hurt and impact commodities. Okay, and that will obviously send the FTSE 100 lower. And if you break out this channel, we all know it's bearish. Okay, full stop. I can argue here from a fundamental perspective that we're going to go higher, etc., based on ECB QE, and given the fact that the inflation target was lower than expected, which means a dovish monetary policy going forward, which is obviously conducive for equities. Stock market thinks otherwise. Okay, so then that's when you leave your logic and your understanding and your arguments to one side, and you have to respect price action. Okay, and if the US markets continue to move higher or lower, then you can clearly see that they're starting to be concerned and afraid about a rate increase, which means higher borrowing costs, and that means emerging markets are going to get hit. So if I bring up a chart of the emerging markets and show you, and as you can see this week, the emerging markets certainly were under pressure. As you can see here, we've broken lower. So I did highlight the fact that we had this topping tail and we had resistance in the emerging markets, and now we are potentially coming into support around this region here. Okay, so them two regions are potentially into support. We had previous resistance equal support, but that obviously didn't hold. Now we do have two gaps above for the emerging markets indices. We'll have to see exactly how that transpires. But again, just highlight the fact of a stronger dollar and the impact that it's having on emerging markets, etc., Okay, the all share index bullish. I did have a resistance level here, which is previous resistance equals support, again breaking out, and this is certainly looking bullish. This next target for me would be the 200 MA, potentially this double top resistance at 730. So from that perspective, certainly bullish. Look at the FTSE 250. Again, if I look at the daily chart of the FTSE 250, this is just continuing its move higher. Okay. If I look at the chart here, let me just get the actual official chart. Okay, FTSE 250 again. You have a bullish engulfing candle, higher highs, higher lows. We're breaking out to new highs. One would argue, okay, we continue. We're in this bullish channel and we continue higher. 17,800 potential target for the IHS continuation pattern. Okay, so very hard for me to argue that that's obviously bearish. Okay, FTSE 350 then, let's just observe that. FTSE 350 again, we are stalling up here around the 3825 level, but again it's an inside bar. And given the fact that if you look at a weekly chart of the FTSE 350, it's very bullish. We're consolidating above the resistance zone. So it would be very hard for me to argue that this is now going to reverse and it's going to be a fake out. given the fact that the QE and obviously dovish monetary policy and so on and so forth. So again, this is something that we need to observe. I mean, we did have this rising. We've got this rising pattern here, but it's not really being respected from a trend line perspective, so we just leave for now. Okay, we leave for now and you observe. So again, we work off the pivot at 3825 and see whether or not the market continues. Again, if we continue to move lower tomorrow, Monday, then obviously you've broken out of this rising pattern, so to speak. Okay, so one could argue that you've broken out of this, and you've broken out of this, and now we're looking to potentially move lower down here. Okay, and again, like I said, if the dollar continues its move higher, and we get bearish, say for example the Chinese market is lower, the Nikkei is lower, bearish headlines, we'll see exactly what sort of analysis and interpretation comes out from journalists over the weekend with regards to the US jobs data, and I'll be updating you and posting you with regards to that. Okay, so again, that's basically where we stand. Now my biggest concern has been the FTSE volatility index, but the market certainly is ignoring that. I mean, we had this bounce here, we obviously sold off, and given the QE and excess liquidity, etc., one could argue that we're obviously looking to move higher. Now the oil is obviously very important. Okay, so given the fact that we are looking at a chart of oil, a daily chart, you can clearly see now oil chart itself, along with the obviously the copper chart as well. It looks like it has an inverted head and shoulders formation. I mean, this can be better, more observed or better observed from that perspective. So again, you are into support with regards to oil, so therefore one would argue you're into support with regards to the actual markets as well. So let me just draw this 1 second. Okay, so just do an extension across, set as default. Okay, so again, we're into support, so one would argue you are looking to potentially move higher. Okay, that's basically how I read things and I understand things. Okay, now the actual sectors. Now I want to go observe sectors with regards to the FTSE 100. Okay, so let's have a look at these sectors. Start with the banking sector. Okay, so go to a 60-minute chart of the banking sector, and we do have this potential bear flag scenario, so that's something that certainly needs to be understood and respected. Potential bear flag, obviously looking to go lower, so that's something that certainly needs to be observed and respected from that perspective. As you can see, double top, triple top, and we are consolidating in there, so certainly an argument for the banks to certainly be under pressure. Oil stocks, again, we are building a base here. Same thing with regards to crude, and if we are building a base here, then this obviously will be the reason for us to potentially propel higher. If we break out this support level, then obviously you switch your FTSE. I'll be switching my bias to the FTSE going to bearish. Okay, 60-minute chart, the retail sector at the moment certainly seems to be some type of wedge type pattern at the moment that's certainly been created here. We'll see exactly which way this goes at present. I mean, there is an argument for a continuation pattern here. So your left shoulder, your head, then your right shoulder, and then obviously off you go. There's a continuation pattern.